Congratulations for taking ownership of your financial plan by tuning into the Federal Employee Financial Planning Podcast, hosted by Mason & Associates, financial advisors with over 3 decades of experience serving you.
Welcome to the Federal Employee Financial Planning Podcast. In this episode, we're discussing 2025 federal employee retirements, specifically the new retirement process. You know, we have to talk about survivor benefits as well as the standard rules around a federal employee retiring. We have recorded previous episodes the year before and the year of retirement. In this episode, we're kind of going to slam those together and also provide some guidance and some new updates to those episodes. We're going to talk best days to retire and more. Folks, remember, unlike many content creators, we're financial planners first and we do this second. In each episode, we share real life experiences from decades of helping federal employees navigate the complexities of your benefit package, as well as all areas of your financial plan. Tommy, welcome to the Federal Employee Financial Planning Podcast.
Thanks, John. Intro is great as always. Looking forward to talk about this. We are, as I think our audience is aware, we're often drawing from what we are seeing as advisors, both individually and as a firm as a whole. So hopefully this is all relevant and, just always some of these evergreen topics. There are always changes that happen, and new concerns that pop up, but just good common themes and topics that come up. And we just recorded on the end of year planning, which the year of and year before and when you retire is not necessarily always going to be an end of year thing. However, it's not uncommon, which we're continuing to see. And I think part of that is just, retiring at the end of a pay period or maximizing your annual leave tends to kind of get us towards the end of a year, December retirement. And some of that might even be mental as I think about it, John, just kind of a clean break. Like, hey, I got 2025, I'm working. 2026, I'm retired.
I think you're right. I think it feels good. And a lot of federal employees, the fiscal year ends in the fall. They want to get through their departments through the fiscal year. Then they have to decompress, maybe get the new person on board who's going to take over for them. So it does feel, in my experience over 15 years, that November, December retirements tend to line up for all of these reasons, as well as starting off the year fresh, not working. In Virginia, it can be a little cold, though. So we have seen people that just work through winter and retire in the spring, too.
Or plan to travel. If you don't necessarily want to be here, either be out where it's really cold and you can enjoy some winter sports if that's your thing, or go ahead and migrate with the sun and go somewhere where it's nice and warm.
So today, audience, is September 10th, 2025, second episode of the day, releasing sometime in October. So we're definitely getting close to the end of the year. We have a couple quick hit, not public safety announcements, but service announcements. One, we hit on this one in the last episode. Interest rates have come down as of 9/10. So we're talking about 6% on a 30-year note or 30-year mortgage. VA loans, even more reduced rates. So take a look at refis if you've bought a house recently, if your kids or friends have bought a house recently, or if you're looking to retire and move. It may not be as daunting or scary as it was before when we were approaching 8% on a 30-year mortgage. So that is service announcement number 1. Service announcement number 2 and 3, we'll just combine it. We're hiring, so look for our job posting that is on masonllc.net. 2 or 3, I guess, is we're actively onboarding new families. By the time this releases, we're probably going to be cutting off end of year onboarding of new clients. What that means to you is if you want to be a new client and you're hearing this podcast, that process starts at masonllc.net. You'll request an intro call that should take place before the end of 25, but the real planning sessions will begin in January of 26. So just keep in mind that we have to protect our clients and our process and make sure that we maintain our process for success. We do that by limiting the times of year where we accept new clients. So I think, Tommy, those are the 3, service announcements we wanted to get out.
Yeah, I think you covered it. Yeah, I think that's all great. As typical, I want to dovetail a little bit on what you're saying because you said it all well. Just elaborate or just some thoughts that came to mind on the hiring you mentioned on our website. I don't think it's publicly visible on the website. So I think if you Google Mason and Associates, associate financial planner, particularly September 15th when it's supposed to go live, you should be able to find it. And some of the folks that we're working with to help us manage this process, it is on our website, but you have to have the link, which I don't know if you want to put that out there, John, or if just go through the process and you'll get the link at that point.
Yeah, I think maybe we'll put the link down in the description. And then also, I know we're posting on LinkedIn, I believe, as well as FPA and CFP. And then we're going to be advertising, I think, to our contacts at Virginia Tech as well to get in touch with alumni from there. So we're growing our team. We're expanding our team after financial planners, then operations. And then eventually, we have a big, beautiful website now that we worked really hard on. Eventually on that website, we're going to have hopefully a careers page that talks about what it's like to be a team member and what it's like to grow your career here at Mason and Associates. That's not live yet, but our first national hiring campaign we're pretty excited about.
Absolutely. And on the interest rates, agree, definitely pay attention, take advantage. We like Cap Center because we believe they're transparent. We've had good experiences working with them. And where my mind is going here, John, is I've had conversations with some people, not clients so much, because most of them had already locked in good rates. Although some folks have moved, and this has been, I guess, some of the conversation. It just hasn't gone this way. Some younger folks that I'm friends and acquaintance with is where this conversation comes from. They bought houses recently and they're watching rates go down. And one, I feel like everybody is an expert on things they're not an expert on. Because I've definitely had conversations of like, my uncle says this is going to happen with rates. And I'm like, well, no offense to your uncle, but if he was so great about where interest rates were going to go, why isn't he a financial planner? And why isn't he the richest person in the world? Because he can make a ton of money if he was an expert in it. I just say that I always have like this healthy skepticism when I hear these comments of like interest rates, predicting them, while it can seem very clear where they're going to go, predicting them is incredibly difficult to do with accuracy, almost like timing the stock market difficult. So yes, we would agree. Seems apparent that interest rates are going to come down, but we've been saying this, many people, for a year or more, so it's difficult. What's happening now is not only is the Federal Reserve changing some of their mind, and I pointed this out too, is the market moves before the Federal Reserve, which is why rates have already begun to come down, is it appears that maybe the economy is weaker than it had been told. So that is changing the math on interest rates as well. And all of that to say, ultimately, typically as I'm talking to folks about Cap Center is, it doesn't cost you anything to refinance. If I were you, most of the time, I would go ahead and take the win now that's in front of you, which would already save you substantial money. And if things don't change drastically, chances are if rates continue to drop, you'll have another opportunity to do it at no cost again in 4 to 6 months with Cap Center or someone similar. So I just say all that because I know I've had some conversations where people are like, hey, should I wait? Because, I hear it's going to get down to 5. Maybe it does. I would err on the side of caution, take the win now, take it again if it's there.
Well, you and I, like normal, agree on almost everything. And the 30-year VA loan, just for reference, I'm seeing 5.6 compared to 6.1 on a conventional. Nice. So we're back into really solid rates here. Mm-hmm. And you have the interest rate reduction. The EARL is an option on a VA. You have traditional refi. Cap Center doesn't charge any fees. So elaborating on what you said is you just refi every 4 to 6 months and keep going. And if you're so convinced that the interest rates are going down, there's no risk to you to refinancing on the way down. It's That's like the only risk to not doing it on the way down is if you literally think that in the 4 to 6 months after you refied, that it's going to bottom and shoot back up again.
Exactly.
I mean, that's literally the call that you're making by not doing it now, is you think that somehow in the window where you can't, it's going to bottom and skyrocket. If we think we're on a sustained path down, You just keep going. And
That's
every
my
quarter
point.
point, and every quarter point is a win.
We're on the same page. Exactly my thoughts. Very well surmised there.
So, audience, forgive us because we're on a tangent, but we're going to tangent for a little bit longer. I have one client who I know is listening to this podcast who maybe just purchased a house, and we were talking through some of the scenarios. One, 6% is much better than 7 or 8, so that made the house purchase very easy. But they're selling their home and buying a new home, and unfortunately, this particular client did not take our advice to open up a home equity line of credit in advance of this process, which would have made everything really, really easy. That's okay, because we're going to put $50,000 to $70,000 down on the new home. We're going to sell the existing home. Then we'll probably do a loan recast or loan modification, or we'll refi, depending on where rates go. So just saying that even with a home buying or relocation, think about your options. Think about loan modifications or recast. Think about having a home equity line in place to have flexibility to make a large down payment, before you sell your current home. I personally, anytime I hear, Tommy, like, I need to make a cash offer, it's like, where's this cash offer thing? Like, the only reason a cash offer seems valid to me is if we need to close in 7 days, or
no due diligence. Yeah.
No due diligence, or if the buyer or the seller doesn't think that somebody with $2 or $3 million and an 850 credit score can't get qualified for a loan. It's like, I don't see how it's any different to the seller, whether it's cash or financing, unless we're just convinced that the financing is going to fall through.
I guess it's just if you're the seller, like, who's easier to work with, and the cash. Like, maybe what I'm thinking there is the appraisal doesn't come back right, and now if you're borrowing money through normal financing, maybe you got to shore it up or like figure out how do we make the math work for the lender. So maybe, but I largely agree with you. It's like, outside of that, you're getting cash as the seller. I guess one is maybe feels more of a sure thing, but I don't even know how true that is. People still pull out of deals all the time in these situations. So yeah, and truthfully, you hear a lot of the advice from real estate agents is like, oh, why don't you do an indirect rollover out of your IRA? You got cash. Or let's say we're going to make a cash offer, which indirect rollover, we got 60 days to put it back or we're taxed on it. So, and sometimes they'll call it your IRA loan, which doesn't exist, by the way. We're calling it the wrong thing. And then the other is like, let's just say we're going to make a cash offer and hope that the financing comes through in time. So that, again, the seller has their cash that they're expecting. And if not, we're going to have to go hit our IRA or some other way to come up with this cash. So I suppose definitely on a soapbox tangent here. I'll take a step back, John. It seems like I think you got something you want to dovetail there, but I just was thinking on the Cap Center thing, truly zero closing cost. And my soapbox here is we've seen there are other lenders, I believe, out there who operate like them, but there are many who also say, hey, we do no closing costs. And what we see, the truth there is when we get those closing estimates is they've just rolled the closing costs into your mortgage. So no, there are still closing costs. You've just hidden it. And now I have a higher mortgage payment. So Cap Center doesn't do that. The interest rate is the interest rate. There's no closing costs. There are funding of escrows and things that's not their cost that gets in there, but just transparency there. And I guess a word of caution. When somebody says a zero closing cost, do a little bit of diligence because it's often misleading.
Good point. Hey, audience, if you're thinking about relocating, have the rates moving down to 6% or sub 6, does that change the stars for you? Does it change your ability or willingness to think about moving? Share with us via email or in the comment section below. Also, if you're hearing these rates and you're not refinancing for some reason, we'd love to hear from you why. So maybe we can help you overcome that objection. So Tommy, retirement 2025, you've already helped one client go through this process. I think DOGE largely Department of Government Efficiency largely was responsible for this, but we finally now have a digital electronic filing for retirement, with the caveat that maybe it's not all digital. So in a few words or minutes, however long you need, share with me, share with the audience, what was it like to take your first client through this new digital experience?
It was a positive experience. It seems like it is a good change. However, there are some things that seem a little unclear, and I'll elaborate. And one of the clients where actually we did this together online, and I got to see this experience, said that their experience is that it was very difficult getting to that step of, I guess, getting into the system or getting it kind of queued up so they were eligible to do it. I wasn't part of that. I wasn't a participant in that part of the process, so I'm not exactly sure what all goes into at this point, like, hey, you can actually go online and do the application. But once we got to the application, it seemed very much like the typical paper form, which also, I guess, a best practice in my mind is we can go pull those old paper PDFs. I believe it's 3107. Is that correct, John?
Standard Form 3107, application for immediate retirement. I believe that one's first. There's a different one for CSRS, if I'm not mistaken.
Yeah, I think you are correct. But anyway, we can go pull those and pre-fill it if you just want to be able to kind of roll real quickly when you go through this online application. But it follows along. It seemed, as you would expect for a digital experience. Now, the oddities are, which I haven't gotten confirmation yet, exactly how this is supposed to work, is as far as like FEGLI continuation of insurance. They ask you the questions like you would on that form of, do you have basic? Do you want to continue it at nothing, 100%, 75% reduction, those type of questions? Do you have the other options of FEGLI? So you fill that out online like you would the form. Makes sense. Then it says like, hey, we need you to attach the form signed. Which is like, why did we even fill this out online if you're just going to ask me to attach a PDF of the same information? So not clear if that's actually the requirement. That's certainly what it appeared to be. And the other was, as far as tax withholding, typical to the retirement application, do you want to have taxes withheld? Yes, we do. We want to have it withheld like it's been withheld. And then it said, well, that's great. We need you to attach a W-4P. She's like, that's different. Previously, it was if you're going to just keep it withheld, how your current withholding is, we don't need anything. If you want to change it, we do. So why we have to attach that? So it's just odd. There were some attachments it wanted, which also, as we walk clients through this, I guess a peek to what we're talking about is, yeah, we want taxes withheld, and let's not get too wrapped up on it, because what's going to happen is once you're adjudicated, we're going to tell you or go with you onto services online, massage your federal withholding to what we think is correct, as well as add state tax withholding, because by default, that's not part of that. And usually we need some state taxes withheld. So again, we try not to get too wrapped around the axle on the withholding on the front end. Like, let's just keep the process moving. On this one, the recommendation was, since they're making us, or at least appear to make us, submit an actual withholding election, hey, just do single and zero. That way we'll have the most withheld, which is probably overkill, but we're going to rapidly change it once we can get into the system and customize it.
I think maybe for the first time in my life, I have nothing to say.
Well, yeah, I guess you haven't been through it. It'll probably come up as we go.
Well, it's funny because as you were talking, I wrote down tax withholding, single, zero, change after adjudication, state. I wrote down all the same things in case you didn't hit on them, and you did. So good job. I guess maybe the one thing that we can also say is we can make tweaks on withholding via IRA distribution, or we can make a tweak via withholding or on Social Security. So we have quite a few options there. Remember, this is a combo episode, the year before and the year of, as well as retiring in 2025. So understand that TSP distributions are a little bit more complicated as far as tax withholding goes. A, it's a pain to dial in the federal, and then B, they don't let you set up the state. So that's why we much prefer taking IRA distributions over TSP distributions. Question is, well, I guess one statement, then question. is you still have to know the answers to the questions before you log into the system. So I think to your point is very valid about downloading the 3107, downloading the 2818 and all these other forms, knowing the answers to your question, watching the Mason and Associates YouTube videos and podcast, knowing what all the 75% reduction means and et cetera. So that way you feel educated and empowered. So when you're filling out these forms, it's not like you've never seen these variables before. So that's one. Where were these people when you applied? Were they at work? Were they at their house? Could you connect via Zoom? Because so many things are accessed via these like special DOD or federal employee, I think they call them cat cards. And it's like, sometimes you don't even know your passwords to things and they just stick the magic card in and everything works. So how did this work?
Yeah, I love it. So they were at home. So federal employee husband and private sector wife were at home for this meeting, and a lot of, I think, good kind of story to unpack here about leading up to retirement and keeping the confidence of this decision going forward. But to answer your question, it almost reminds me of our previous episode. You said, like, I was surprised when I showed up and the client's children were in the room. Like, I didn't know they were going to be there. It was great to have them. And that's kind of how this went. I knew we were talking about the process, and I was like, well, I guess you probably can't share the application. You probably got to be like at work on a secure computer that's not going to let you jump into this meeting. To my surprise, John, they said, well, actually, I'm in it right now on this other laptop that was not a work laptop, so I guess you can get to it without being in that ultra secure environment. So they joined the Zoom meeting from the other computer that they happened to have with them. I think they were laughing that they had like 3 computers going during this meeting as they were looking at different things. So it wasn't behind that like secure work firewall setting. We were able to get in there, at least based on that experience, and see it, much to my surprise.
Well, that's really, really cool that you were able to do that. And, I'm kind of joking around in my head right now, but I'm like, I wonder if the website is http:// I want to retire. And it's like, it's not even a secure website. I really hope that's not the case. I'm sure it's secure, but it just one of those things that pops into my head. It's like, maybe it's not even a secure website. Anyhow, that's just me being funny, but it's awesome to be able to take clients through the process. We've been doing it, me for 15 years, Tommy since 2019, helping federal employees fill out these forms and printing them and signing them and notarizing them. So it's just nice for us too to be able to now actually help with the click pattern. Tommy, it doesn't matter how many times we can educate our clients on these things. Ultimately, even like Social Security and Medicare, the Medicare Part B application, I'm sorry, audience, I'm sorry, clients, if this makes you feel bad, couldn't get much easier. It's like a few buttons, yes, I want it, and then you're done. But when you've never done it before, and it's your first time and only time ever applying for Medicare A and B, what seems so basic to us is still scary to you. And I'm really excited now to be able to help people through that click pattern, because there was a certain amount before where you'd help them fill the forms, but then they'd have to mail it or turn it in, and it just felt incomplete. Now it feels a little more complete with what you've been able to do.
Oh, I love it. Because if we can continue doing it of just like, hey, let's actually submit that thing online together. I'll walk right beside you. And even on these attachments. So that was part of it as well, was like, okay, well, here's the FEGLI continuation form, how it should be filled out. Make sure you sign it, attach it. Here's your W-4P. So just really trying to make it as easy as a process as possible for clients as we go through it, which they seem to be very much appreciative. Same thing with Medicare and Social Security, John. Like, we go through it and it's like, this isn't really, hopefully this isn't offensive or anything to anybody. It's not like rocket science, right? But we do it all the time. And I was thinking about your Medicare example. So we're efficient. One of the questions on that very easy application, when you do them enough, is, do you have group health coverage? And I think that question trips up people every time they see it, particularly for our clients, because they do have group health insurance by their definition as a retired federal, they have FEHB. And so it's just very quickly explaining, hey, that question is asking, do you have group health insurance through your current employer that you're employed, actively working? Yes, you have group, but you are not actively employed. That's what they're looking for here. So no, you do not have group health coverage for purpose of this question. So it's just one of those things where we can very quickly clear the fog because we do it. It's not overly complicated, but I definitely get when it's your first time seeing something, just like, what exactly? And we're all, as a society, I guess, at this point, in particular our federal employees, very cynical and skeptical and untrusting, right? So you see a question where you're like, that could be interpreted multiple ways, and I'm not going to answer it until I fully understand it.
So maybe continuing on the Social Security and Medicare, the year before a year of retirement, many federal employees are going to retire at 57, have the first supplement. But there's a lot of people that will retire 62 or later. And I think it's important just to quickly hit on, Tommy, that the decision to retire is not necessarily linked to your decision to activate Social Security. And generally speaking, we're fans of one person activating early, the other person delaying until 67 or 70. That tends to be a really good sweet zone for us for a lot of reasons. And you can go back, audience, to previous episodes and listen to that. But that tends to be our recommendation. So just think about that too. The decision to retire is not necessarily linked to when you activate social, and the decision to activate social, hopefully you're educated and empowered to make a good decision and you're not doing it out of fear. Common things would be like, I want to activate my social because I don't want to take a TSP withdrawal, or I want to activate my social because I think the whole government's going to go bankrupt. Well, if that's the case, then your first pension's gone too. So we're really, up the creek without a paddle regardless there. So, and then we talked, Tommy, a little bit too, which I think will dovetail right into survivor benefits, is I'm going to live forever or I'm going to die tomorrow. And people tend to say both of those things.
They don't say it directly. You have to read into it to ultimately distill it down to that. And it is, but yeah. So keep going with it.
So the Social Security claiming scenario is like, Tommy, I'm going to die tomorrow. I need to get it while the getting's good, and it's like, well, okay. And you also want to decline survivor benefits? This doesn't make sense, or then we'll say, we need some life insurance. And like, well, I'm going to live until 90. It's like, okay, well, which one is it? We're activating social because you're going to die tomorrow, but we're also going to decline survivor benefits because apparently you're going to live forever, and it's just funny to help people through this claiming process or claiming decision. So maybe we can also just say, as you lead up to retirement in 2025, full survivor benefits is the answer 99% of the time. 0% or even the half survivor benefit, in our opinion, really not on the table for 99% of the people out there, in our opinion.
I think you're right. There's always going to be some exception case that could probably, in an extreme enough situation, you could paint a picture where we could get on board with, okay, this very rare case, sure. But 99.9% of the time, yeah, survivor benefits is the answer. John, you and I talked years ago. A lot of times too, it's, okay, we agree that survivor benefits is part of the answer. One, because the pension and that benefit is valuable, because we want our spouse to have access to FEHB, which means they have to have a survivor benefit to maintain that access, as well as have been on FEHB. And so that means zeros. If we've gotten to the point that zeros out of the picture, well, now we're at the 25 or the 50%, 50 being the full benefit, maximum benefit you could do there. The cost difference at that point, we would say is it's full survivor benefits. Really, what are we talking about? The cost difference here. So that's part of that decision or logic of how we could get there. What we will see, John, too, easier, I think, for people to think about things a different way, and we try to steer it back, is if we have two federal, right? And so that's where I think sometimes the logic or the thought process is, well, I'm going to have my pension. They're going to have their pension. They're going to be fine. They're going to have their own FEHB, so I don't have to worry about SPP to leave FEHB health benefits to them if something happened to me, which we certainly have our thoughts on that as well. Yeah,
need is always a very interesting word. And, I'll share with the audience. I bought recently a 2006 Toyota Corolla, and the check engine light comes on sometimes for $700 because I didn't want to drive my 3500 around town, 3 to 5 miles a day. I didn't need that car, but I certainly didn't need, a $30, $40, $50,000 commuter car to go 3 miles a day either. What I'm getting at is there's a lot of things in life that we don't need. We don't need to go on vacation. We don't need maybe to eat organic. We don't need to go out to eat. We don't need to drive $70,000 vehicles. We don't need to wear designer clothes or have jewelry. So there's a lot of things in life we don't need that we choose to buy because we find value in them. We would argue that having full survivor benefits may not be a need, but it's something that if one is properly educated on, you'll see the value in it and you'll believe that it's a good purchase. So I think that's just such a good thing for people to
Peace of mind.
Peace of mind, and the decisions that you make when you have full survivor benefits are just different. We'll link, hopefully our team will do this. Our number one YouTube video, I'm pretty sure, is survivor benefits. We've talked about this at length in other episodes. Just a couple of thoughts there, Tommy. If you can't afford to retire with survivor benefits, then you can't afford to retire. If that's what's going to make or break your retirement is the pre-tax 10%, then you need to work another year or more to be able to get over that hurdle. Another one that we've said for a long time is if you can't afford to do without 10% pre-tax of your pension, how is your surviving spouse going to be able to do without all of it at your death? And these are just things that we help people understand. It's like, what are we really talking about? And then keep in mind that declining survivor benefits nowadays, you're also likely declining Social Security benefits for your spouse too, because we have a lot of dual income families and you only get to keep one social when one of you passes away. So for a lot of folks, you can only protect half your income anyhow, and you're voluntarily, just getting rid of all of it. Yeah, it's hard.
Yeah, I love all of that, John. And I think part of conversation too was pointing out, I was like, hey, on the one hand, you're saying you're going to live forever, so I don't need survivor benefits. And also, I'm not waiting because I'm going to die soon. I'm not waiting until that break even on Social Security. So I'm turning it on early, which people usually enjoy that analogy as they think it's friendly conversation. And usually we're all chuckling as we reflect on it. Another part is navigated this recently, John, which I think we all would say it in some form or fashion. You kind of already are, is it's like, don't let perfect get in the way of good enough. I think you're trying to mathematically build this model in your mind of, I'm going to optimize everything. And by not taking survivor benefits, I'm going to invest it and it's going to grow to this or that. It's like, well, what about the loss of the peace of mind that if it doesn't work exactly to plan how you're sketching it out in your mind? And the other part that I believe resonated was, I'm willing to bet you taking survivor benefits doesn't change the enjoyment of your financial plan one bit. I am guessing that you are going to have exactly the same enjoyment in your financial plan, but with a much greater peace of mind. And to your point, like, what does that free up mentally, knowing you have survivor benefits and how you navigate the rest of your plan? So I think those tend to resonate too, is like your enjoyment of your plan is going to be the same. Just one of these feels a whole heck of a lot riskier.
And you're going to make the same or more money in retirement, more than likely.
Right.
So you're getting a pay raise and you have full SBP. Your decisions, audience, either complement or conflict. You either plan or you react. These are things we used to say when we were doing public seminars. And, it occurred to me, Tommy, that declining survivor benefits because you're going to live forever, but then also activating Social Security because you're going to die tomorrow is really a double whammy. Like, you're getting hit both ways, because let's say you do die at 63 or 64 years old. Well, now you kind of messed up your spouse twice. One, we didn't delay till 70, so there's no gigantic survivor social, and we declined SBP, so there's no income there. You lose twice. Mm-hmm. So your decisions neither complement or they conflict. Maybe there's a world where I could get on board with declining SBP and delaying your social till 70. At least we're kind of like hedging our bets a little bit. Or maybe it's like, take full survivor benefits and turn social on early. Like, but it shouldn't probably be
It's funny. It's funny you
decline
say that.
and,
That's even part of the conversation, which I believe in the scenario that I'm thinking of, we got to a place as a advisor-client relationship of we're going to turn on SBP and we're going to delay Social Security for one, take the other early. But the delay of Social Security was we're probably looking at age 67, even though the math says I'd like you to delay it to 70. Like, I realize that's asking a lot. There's a lot of things that go into this. It was the don't let perfect get in the way of good enough conversation. It was like, I feel pretty strongly about survivor benefits on that pension. Social Security strategy, I can be a little more flexible on. I mean, ultimately, it's your decision. So we don't want to say that we're dictating to clients. Though if advice is never landing, we don't know what the point of the relationship is. But all this to say, Social Security timing, I feel a little more flexible on that. Particularly if we can agree, we'll take one early. Let's try to delay yours as long as you're willing to. But so, yeah, I think it's dovetailing exactly to that conversation that you were talking about. Thinking about maybe going back to maybe a little bit of like the process and prep for retirement and the confidence building, but don't want to move us off the where we are on the topic at the moment. There's more you wanted to hit on.
Well, like normal, we're on the same page. So November 29, December 31 look like ideal times to retire. Tell me at the end of this year. And, quick recap there, end of a month, end of a pay period is typically what we're shooting for under FERS. That just gives you the optimal time to retire where you don't have a gap in pay. So I think that's important. And I guess maybe we could just quickly talk about FEGLI. Maybe, I don't know. Do you want to talk about FEGLI elections? Do you want to talk about maybe like TSP and service transfers and like preparing for your retirement income? Where do you want to go?
I think let's kind of hit it all. So I'm going to try to think about like mentally how this conversation or kind of like lead up goes. So typically we're working together, building the plan. Everybody's feeling good. And then it's like game time. Okay, we're kind of like in the year before or like right around retirement. So let's rebuild confidence and make sure we've got the tactics down. So part of this is just like, hey, what's the actual pension and cash flow? What's it looking like here? Like, my salary is going to get cut off. So it's number one, here's a quick recap of the process. You're going to retire. You're then going to get your final pay. You're then going to get your annual leave. So probably the first month of retirement doesn't feel like anything changed. In fact, probably feels like you got some bonuses. Then you're going to go into interim, which maybe that's going even faster with some of this, Doge electronic stuff. I'm not entirely sure at this point. But your interim pay, probably about 70, 80% of what your final gross will be. But ultimately, when we adjust for taxes, FEHB and things, that interim pay is probably not going to be that far off of what your actually adjudicated pay is going to look like. There may be some change. Then you're going to be adjudicated. So that's your new pension set. And we're going to go into services online, make any adjustments to withholding we want to. So that's kind of the quick recap on the process. The other part is I think through a scenario of going through this with a client was, well, what's my pension going to look like? And this one was, you mentioned a supplement. So it was like, we're going to have a supplement and we're going to have the pension. We estimate it to be these amounts. And while there's some variability in your tax projection right now, particularly because the spouse's income, gets bonuses and stuff changes, right? We have to dial it in every year. Roughly, when we adjust for taxes right now, here, and we adjust for FEHB premiums, X is what we expect to hit your checking account. So that's your net pay from these streams. That's helpful for a client to then be like, okay, well, now I know what I have been netting. You just told me what I will net. Thank you for making sense of that. What about the delta, assuming I want a full replacement, which is what we're typically shooting for. And so that's when it's, hey, is anything in life changing that would change the need for it to be a replacement? But absent that, IRA distributions, TSP, most likely IRA is what we're looking at to replace it. Here's the distribution percentage. And this is healthy, not healthy. Our Social Security strategy comes into it. That's when all of that's laid out. And ultimately, we're going to take probably 3 to 5.5%. Maybe while we're delaying Social Security, we could see even higher amounts depending on the situation. Net it out for taxes. We'll account for that. Here it is. Your cash flow stays the same. everybody feels confident. Mason and Associates feels confident in your plan. We're good, right? So we've gotten through the cash flow part of it. And then we want to talk about FEHB and FEGLI. And I think
let me touch on just real quick. A lot of times we'll do like mid-month distributions, Tommy, from the IRA, because all the pensions tend to hit the first of the month. Federal employees like to get paid twice a month or every 2 weeks, so we can stagger those distributions, which I think is helpful. Beware the first supplement retirement gap, where you don't get any interim pay for your supplement, and that's all back paid at the end. So that's something to be aware of. As far as like when to submit your application, what was communicated to us is that there is value in submitting the application well in advance of your planned retirement day. And what I mean by that, Tommy, is the retirement processing people are still going to handle the June pile before they handle the October pile, right? They're going to handle those June ones first.
Right.
But you could still be on top of the October pile. You could still be the number one in that list. So there is some value in getting your application in early. We typically say at least 3, maybe closer to 6 months in advance. Generally speaking, under the old system, Tommy, I mean, we were seeing adjudications in 2 to 3 months, pretty common.
Yeah.
All over the internet, all over websites and Reddit, and people are talking about 6 months, 12 months, and I just have never seen that. So I don't know if people are just A, very unprepared, or B, submitting very late. But historically, we have not seen.
I guess these certain agencies are maybe better than others.
Possibly, yes. And so plan for 6, but know that it can happen in 2 or 3. If you are divorced or you have special considerations, plan for 12, could be 24, because now all of a sudden we have spousal adjustments and spousal annuities a whole court-ordered process, which can be a nightmare. If you were to do a TSP transfer, Tommy, which we recommend that, is go ahead and do an in-service TSP transfer to an IRA, whether it's at Vanguard, Fidelity, Schwab, or with somebody like us. Know that that's a process that takes, 14 to 30 days.
Yeah. And so we walk through this with our clients as well. And that was part of the scenario and really typically part of this process. So we're firming up retirement, the decision. And as part of that, let's get this TSP rollover in motion, which is, how we continue our relationship, but also going to give you flexibility, better service, because we're here processing things as much as we need to, change withholding. And as part of that process, hey, let's log on to tsp.gov together. Step 1, if we're in agreement, let's get Axos as our custodian, Axos Advisor Services. Let's get them, it could be Vanguard or whoever in your situation, as a financial institution on file. And the reason we do that in the IRA or Roth IRA account number is it kicks off a blackout window, which I believe is 10 days. So just getting that on file is a good security measure. I get it. In case somebody who's not supposed to be putting things on file does that, they're going to send a letter out and a text message saying like, hey, something's changed. Nothing can happen to your account during this window. That opens back up. Now we can actually process or submit the actual rollover application, which we're big fans of partial rollovers and the majority of your account being in that rollover. We like to leave some money at TSP just in case we ever want to have money go back. As long as the account's open, that door is a revolving door for a variety of reasons. Go through the wizard together online to get the application going of the partial rollover. Final step is 1, we're going to send a security code to you. Then if we have a spouse, which is typically the case, we're going to send a DocuSign to the spouse to say that they're okay with this rollover as well. So spouse has to execute that DocuSign. Then TSP will begin the process of actually selling the funds in the account, cutting the check, and sending it to the address that you've said to have it sent to. So it's good to get all that done ahead of time and then have the IRA ready, right? So it's going to show up in an example at the Mason and Associates IRA that we're managing for you. We're already going to have it linked to your bank account. We'll handle the investments. All that'll be happening. And then, it'll be seamless for you. We'll either have a systematic monthly that we've already agreed to set up. If we need a one-off distribution, we can do that very quickly if we need to adjust. So it's just a much more seamless, flexible situation. And you're not going in, because if you didn't do this and you retire, TSP, I believe, is going to go into like hey, you can't really do much of anything until X amount of time. And we've like cleaned our systems up. And even if you can do it, because we're switching you from employed to retired. And even if you can, we're going to force 20% withholding for federal and non-state. So it's just, you can only do X amount. I think it's one per month, but it's just far more seamless transition, less feeling like emergency panics around cash flow. Get that IRA ahead of time.
Love everything you said, Tommy. Ultimately, one of your big choices here is, what website do you like better? What customer service team do you like better? Where do you get the most flexibility? We would argue that for all of the greatness that TSP has, distributions are still challenging, and it's infinitely better than it was a decade ago, but it's still challenging. And as we think about distributions, I think what's important for folks listening to this podcast to understand is that we understand that it is going to be a transition for you to spend your own money in retirement. You say this very well, Tommy. What served you well, what was a strength your entire career, has now become a weakness. And if we're turning on Social Security because we're scared to take a distribution, that's not a good reason necessarily to turn on social. You have your go-go years, your slow-go years, your no-go years, understanding the plan, understanding what's possible. There's a risk for all of our federal employees that they could run out of money one day. And I'm only talking investment dollars, because I don't really think there's a risk that their pensions go away. I guess it is a risk out there. I just don't see it happening.
It's very low on the risk totem pole.
So yes, there is a scenario where federal employees, if they take distributions, could run out of investment dollars. There's also a risk that says you could die with 3, 4, or 5 times the money you started with, that you never got to enjoy any of it. And I could make an argument that both are equally bad outcomes. And maybe the worst outcome of the two is never enjoying any of your money and having it just stockpile up so that you can pay more taxes to the government one day, never get any enjoyment out of it, create a tax nightmare for the people who inherit it. At the end of the day, inheritance is still good.
Right.
At the end of the day, even if a lot of federal employees run out of investment dollars, their plan's always going to work. They just have to adjust to the fact that now they only have X amount of pension income, which for a lot of folks, they could still sustain life pretty well. So I think both are risky. 3, 4, 5% distribution rates are prudent. Audience, we hear you. We've done this for decades. We know that it's scary. If you're scared and you haven't committed to that big retirement trip or spending your own money, it's likely because you're not confident in either the math that you've done or the math that your planner's done. Hopefully that's not us, by the way. Or you just need to live it for a little bit, Tommy. But it's going to take a little while, but you definitely need a team to help you get confident in the strategy that you're going to use, because it can be scary to pull money out of the piggy bank.
Sometimes it's phases too, right? Of like, let's just get you confident this is going to work. And even without us getting you to enjoy life even more, just, hey, your cash flow is going to be the same, and get you comfortable, confident in that, get you retired and get you confident that the rug's not going to get pulled out from under you. And then we can continue working on the confidence of, hey, you should think about some of the other things you wanted to do in life. What are they, and how can we help facilitate? And yes, you can do it as we talk. Or as John has said before, and this is probably maybe from Mike or Kim where you got it, we're also not going to tell you a fairy tale. So you can rely on us to say, like, that's not a good idea. That's not sustainable. Well, certainly that's not where we want our default to be. Most of our clients are prudent, responsible people. So again, it's more of a conversation of, you can actually probably do more than you think you can. But if it seems like we're teetering down an unsustainable path, we'll certainly let you know that as well. John, as I kind of thinking about some things to cover here, I think maybe we wanted to hit on, one, the estimate, kind of maybe stepping back, because we had a situation, we see this occasionally, where the estimate from GRB is not necessarily accurate. It doesn't mean that your retirement will be processed inaccurately. It just means pay attention. So probably want to hit that. And then I was also thinking about maybe some like FEHB and TRICARE for life stuff, maybe getting sprinkled in here.
Yeah, so GRB could be wrong for a couple of reasons. One, they don't have your years and service time correct. Maybe they don't have your high 3 correct if you had a unique scenario. So that just understand years service, high 3, all the factors that go into this. Maybe it doesn't capture your military time that you've purchased or your academy time that you've purchased. Maybe you had a break in service. Maybe you have a part-time factor. We've seen GRBs wrong on both sides, over and underestimating. Further to that, Tommy, is the GRB platform is going to assume what people tell it to assume. So yes. Tax withholding, FEHB elections and retirement, FEGLI elections and retirement. And oftentimes folks will look at this and they'll say,
oh my God,
that looks terrible. I worked an entire career to make X. And it's like, well, wait a second. Taxes are way off. We're going to take the 100% reduction on option B. We're going to do the 75% reduction on FEGLI basic. And oh, by the way, we're going to scale you back from FEHB standard to basic and save $200 or $300 there. And all of a sudden you're making that net go up rather than go down. So GRB can be materially off or materially misleading, not maliciously, but based on user input.
Oh, it's making assumptions and user input, like you said. And also it's not the entire picture. So we're looking at your investment assets, your Social Security, kind of how does this all tie together? But yeah, typically the net you get out of that system is not the same net we're going to end up as we start massaging things and customizing it for you. I have to say as an aside, that academy time was really cool to see recently. So we see it on the LES that it's been paid for. But man, talk about probably the best investment ever as far as buying that academy time. It was like $800 to buy it back, which had already been done, and resulted in $800 more per month in the pension. It's like, that is amazing. So yeah, always cool to kind of see that actually in real life taking place. But one of the things that doesn't seem to be caught in that GRB estimate. So just be on the lookout for it. And of course, watching it as you go through adjudication, that they are capturing that time correctly.
I believe, Tommy, the formula is 3% of base pay to buy that military time. So 3% of when you were in the academy is a very small number. If you don't do it within 2 years of joining federal service, they start tacking on interest to it. In this case, it still would have been a very reasonable purchase. This leads me down the path that says, if you're thinking about retiring soon, have you purchased all of your time? Is all of your time paid for? Whether it be military, breaks in service, part-time service, whatever the nuances are, have you purchased or do you have credit for all of the things that you should have credit for? And we've seen issues with people retiring under the reserves, not buying their active duty military time, not buying the academy time, breaks in service, or maybe you separated, took a refund and went back. I mean, there's a lot to unpack here. Hopefully you're doing that well in advance of your retirement. Our understanding is if you're going through adjudication and they uncover things that you could have paid for, they're supposed to bring it to your attention. But a stronger position, Tommy, would be to have already done all of that in advance.
We want to plan, which is to be proactive and intentional versus reactive, as you just said. So yes, maybe somebody will uncover it and you'll get to react, hopefully appropriately. But yeah, we want to be on the front end of all of this. So it's a smooth sailing, no surprises.
Maybe we can also say, just from like an emotional standpoint, we understand that federal employees who make X, who retire with Y, and Y is less than X, just from a pension standpoint, and then seeing the GRB be low, we understand that can be emotionally troublesome. But if FERS is very low, but now we don't have to have any taxes withheld on an IRA distribution, we're okay. It's our total income that we care about.
Exactly.
And I think sometimes people can get wrapped around the axle where they're like, I need my FERS to be higher, and it's like, but your net is where we want it. It doesn't really matter, where we're doing the tax withholding or where we're paying the life insurance or health insurance premiums for. It's just a tool.
Yes. Well, yeah. It's all part of a bigger puzzle. It's one, realizing that like your gross pay was never your pay, right? Because we had things like Social Security, Medicare, different deductions. Going out of that, we were saving. So like what we're really focused on is what were you netting and what was your lifestyle, that net. And then, we've got other assets, other income streams here to get you back to that or more. And we're going to show you. And John, I was thinking, we love our financial planning software. It is very powerful, and it's great for strategic projections, like really go into the bigger picture, somewhat maybe tactical kind of year by year, but it's really a good strategic tool. But oftentimes for this conversation, good old Excel spreadsheet of just showing here's your net from your FERS, here's your net from Social Security, here's your net from your investments, whatever they are, to get you to X. Now, does this all make sense? And then, and that's just so easy and powerful for people to see, like, okay, I get it now. That's all I needed to see.
A whiteboard, an Excel board, sometimes the more sophisticated the software, the more concerning or troublesome or less like we start questioning.
It's just harder to digest it, I think, particularly that kind of like, here's your snapshot for the year. Like, it's just very easy for you to understand. And then we use this to see like, longer term, this is giving us some messages of how we're going to take advantage of things, but how just your back of the napkin can be so powerful for somebody. I think it's confident to see it both ways, right? Where they can say, man, it's really neat to see like all the thought and the long-term strategy and how you guys are planning and how you're going to bob and weave based on what you're seeing and add value. Like, that's so cool, because I've never done that strategic, or if I did, I didn't have faith in it. But then also to see like just very digestible what this means to me this year. That's awesome.
And maybe emotionally too, or from a demonstration of competence, having your financial planner be able to just like build something in front of your eyes at the exact instant to show you what your pension's going to look like, or be able to walk through an Excel sheet and deliver something so simple and so, I don't know if profound's the right word, but meaningful. It's like we inherently don't trust software, but like when you walk through a whiteboard or an Excel, sometimes it seems like we have a little more credibility, like we actually understand how we got there. Maybe where maybe people assume that the software just did it all for us.
I think well, you might be right about that. I think it's also just the software is overwhelming, the amount of information that it's trying to convey, and again, I think it's a lot of times tilted for a longer term conversation versus the like here and now. So I think it's just, kind of combining both of them. I do think if all an advisor is using is back of the napkin, I'd be concerned probably about that as well, because these are both tools, right? So you need a professional and you need them to have the tools. One is, highly relying on them and their ability to do it back of the napkin or on a quick Excel. But the other is like looking at many complicated factors that go into a long-term plan and that they probably know, but to do it without a tool or something to help coach, just help make sure they don't miss something in that longer term, and I just start thinking about things like, how are we layering all of our income? We probably know intuitively, but software can help us think through that. What about RMDs, QCDs, inherited IRAs, any annuities? Like, it can very quickly long-term get complex, and that's where software helps the professional visualize it, and then they should be able to present it in a way that's understandable and what's important to you at the moment.
Agreed. So maybe a couple of quick hit items because we're almost an hour in. For FEGLI Basic and FEGLI Option B, Option C, we have plenty of YouTube videos, audience on all of this. We would say that generally speaking, the bulk of our clients take the 75% reduction on FEGLI Basic. Generally speaking, if you can afford to retire, you can afford to die, especially if you have survivor benefits. We're typically either dropping Option B or if you're close to 65, electing the 100% reduction. Similar for Option C. Option A just reduces down to 25%. So those tend to be, Tommy, the recommendations, but you need a financial planner. You need to have a game plan of what you're going to do so you can answer those correctly.
I gotta say, John, I love you just gotta restate it. If you can afford to retire, you can afford to die. It's a powerful statement. I know Brock Buckles from BC Brokerage loved that statement. I recently used it to drive home a point to a younger client. As far as our firm is concerned, younger, they loved it. So I just want to shine light on it again because it's apparently, we do it all the time, so we take it for granted, statements like that. But I just find it to be very impactful when people hear it. They love it.
That's awesome, man. 5 years, you have to have FEGLI for 5 years leading up to retirement to retire with it. Same is true, Tommy, for federal employee health benefits. So just understand that, the 5-year rules, we're not going to go into nuances on TRICARE for life and all of that right now. If you do have TRICARE for life as an opportunity, we would encourage you to explore what it means to enroll in federal employee health benefits and then suspend. Again, we've done episodes on this stuff before, as well as episodes with Brian Gay that talk about Medicare. So I think we have a lot of content out there that if people really want to, people keep saying this online. If they want to double click it, if they want to double click on this topic, we'll go look at some of the other content that we've produced. You can double click a long ways and zoom in a long ways to go deeper into this stuff. So
when this episode airs, John, we'll be over 100 episodes, if I'm not mistaken. I think we just put out our 99th, and there'll be a couple ones ahead of this. So really cool. A lot of content out there.
We've got to be one of the top producing contents for federal employees, specifically around financial planning, tax planning, and retirement. Beneficiary designations, make sure they're right. I'm trying to think of any other quick hit items. Let's see. 75% reduction, beneficiaries. Keep in mind, like your long-term care premiums and those rate increases, every dollar matters, Tommy. So, if we can dial back what you're paying to long-term care, then we can dial up a distribution to somewhere else, or we can take some stress off the portfolio. We get really excited anytime we can save a client $100, $200, $500 because it really does add up to a material impact over a lifetime.
I think it's great. I know we don't want to go down it too much, but long-term care continues to be a troublesome area. For those with existing policies, you're probably getting premium increases. Genworth is certainly front of mind right now for those private policies. As John has said in the past on a different subject, I think it was around FEGLI, these premium increases are, maybe it's not like a license to shop because I don't really know how much shopping there is to be done today, but it's a license to consider. So it's not a license to drop it. We probably don't want to drop it. You've been paying for it for a long time. We want to retain the benefit because it could be pretty powerful as well as freeing, but we don't have to just accept whatever's being proposed is ultimately where we're going with this, is that let's slow down. Let's see, maybe we accept it. Maybe that is the right answer. Maybe we can request some alternative options from them that they don't present by default, which probably means a reduction in some form of your benefit on these other alternatives. But maybe that's what's right for you and right for your cash flow. So let's just stop and take a look and think about our options.
Great point, Tommy. Well, let's do a big congratulations to everybody who's listening to this podcast that's retiring at the end of the year. Thank you for your service. Thank you for serving our country. We hope that you have a wonderful retirement into 2026. If you're a client, thank you for being on this journey with us, both on the podcast as well as the relationship we have with you. If you're somebody who is looking for a relationship like this, like we said, we'd love to help. And that process starts at masonllc.net. Any closing thoughts for you, Tommy?
I think we've covered it all. I'll also support, our entire firm supports that. Hats off, congratulations to anyone as you're eyeing retirement, a successful career, great habits have gotten you to this point. If we can work with you, certainly welcome it. But regardless, thank you for listening. Either an hour of this episode or the over 100 we should now have out there. And we appreciate any feedback. So thank you. And John, thank you, for doing this with me as always.
Oh, it's my pleasure, Tommy. And yeah, we have a lot to celebrate with 100 episodes, and you and I keep moving the goalpost, and our firm always moves the goalpost, but reflecting and enjoying the consistency that we've been able to deliver for our clients and audience is pretty I'll say remarkable that we've been able to dedicate this much time to producing this much content and more to come, audience. Here's our request from you. A, thank you. Many of you have listened and become a client, which is wonderful. But B, it's motivating for us to see comments, emails, knowing that we're helping. If you are feeling helped, if you are feeling like we're doing a good job, leave us a comment, shoot us an email, say, rock on, guys, you're crushing it. Thank you for 100 episodes. Do something to show us that you enjoy it. Even if you don't want to do it externally where we can see it, share this podcast and what we're doing in our YouTube channel with friends, families, coworkers. We know it's changing lives. And by that, every person you share it with, you're changing their life and you're being their hero at the same time. Thanks again for being on this journey with us. Folks, is our content helping you make more informed decisions? Do you feel educated and empowered? Have you made positive changes in your plan since you started following our show? Again, please do your best to continue to spread the word for us. Leave us a comment, shoot us an email to masonfp@masonllc.net. Thank you for tuning in to this episode and every episode of the Federal Employee Financial Planning Podcast. Remember, we're financial planners first. We do this second. And as always, we hope you leave this episode and every episode feeling educated and empowered to make positive changes in your financial plan.
The topics discussed on this podcast represent our best understanding of federal benefits and are for informational and educational purposes only and should not be construed as investment, financial planning, or other professional advice. We encourage you to consult with the Office of Personnel Management and one or more professional advisors before taking any action based on the information presented.